Welcome to our basic tutorial. This is just a short video for those of you that actually haven't had any experience in the stock market. Maybe you've seen charts on TV, on films and things where the gangsters have got a screen up with this random chart on there, and you recognise it as a stock market chart, but you don't actually know what the hell's going on with it. Hopefully by the end of this video you'll have a bit more of a clue. We're hoping that this is going to be your first of many lessons, because our tutorials are set up in a way that you start at number one, which is this being number one, and by the end of the advanced tutorials you'll actually have enough to look at a stock market chart and say, I think that company's going up, or I think that company's going down. So that's our aim, and also what you should see by the end of this video is actually how simple it is. It looks very complicated, but once someone actually explains to you, this is what this is, that's what that is, it's not as hard as what it looks, and that's what you'll learn by the end of this video. So let's crack on. Right, so what is a chart? Charts are a visual look at human reaction to fundamental news. Now that sounds a little bit complicated, but it's actually a fancy way of saying, like the BP Macondo oil well blowout that was on the news, where the oil was leaking into the sea and I think about 12 people died. They paid millions in compensation, and that would have affected their share price. And the reason why is a company is only valued by how much money it's worth and how much money it's making. If something happens in that company that affects next year's targets, like Tesco with their profit warning, their share price went down quite a lot over that, because it's the valuation of the company. So a stock market chart pretty much is the price movement throughout the day, but it's also a reflection of how investors are actually valuing that company, because a share is a valuation of a company. If a share price goes up, then the market is valuing that company more. So it's quite simple really. Right, so in general, if something good happens to a company, the share price will go up, because that is the valuation of the company. That's what the company's worth. If you take all of their shares, even if they're £1 a share, they'll probably have millions of these pound a shares. If you owned every single share, you would own the company yourself. So that's basically what it is. When you buy a share, you're buying a slice of ownership of that company. If something bad happens to the company, then the price will go down in general. So here, what we have is the green candle. If you see a green candle, you know that the price opened in the morning and it actually closed higher on the afternoon, because the stock market opens at 8 o'clock and it closes at 4:30. It doesn't go out through the night and things like that. So if you look at this, you've got the price down the middle. The green candle opened at 102, which is £1.02p a share. It went down initially. That little black, this is why they're called candles, because they do represent a candle. If we call it the wick, what that means is the price opened at 102, it went down to £1, like 100 pence, and then it went all the way up to 106p, and then it closed. So at 4:30 in the afternoon, the price was 106, the market shut, and that was recorded. The computer programs recorded that was the trading range for that day. If we look at the red candle and say that's the next day, so the market opens at 108, it goes up to 110, which is the high of the day, because it actually comes down then. When it's red, we know that it closed below its open. So at 110, it come all the way down to about £1, and then it went back up and it closed at 102. So as you can see, it's quite simple to actually work out. It's a little bit like when we was at school and we had graphs and charts. You'd have time along the bottom, price up the side. That is basically what it is. So let's have a look at a proper chart. In fact, before we show you a proper chart, something else you need to know. Sometimes you get an open, you'll have the price movement. So in this example, it opened at X price, it went up a little bit, and then it went down quite a bit, and then it come back up and it closed at exactly the same price that it opened. So there you don't have any green or red body, you just have if you don't have a green or red body, you know that it opened and closed at the same time, at the same price. So that's what this means, and they appear quite frequently on charts as well. Right, there is another way of actually showing price movement on charts. Some traders like this version, like on the screen now, and others prefer the where you have a candlestick with the red and green bodies. If you see this one here, which sometimes we use, on the left hand side of the bar is the opening price. The high and the low are marked quite obviously, and then on the right hand side of the bar you have the closing price. So the example on the left opened and closed, so that was a down day. That's what we call a down day, because it closed lower than it's opened. So the share was worth more in the morning than it was in the afternoon. The converse is true for the one on the right hand side. What actually happens, it opened, it went a little bit lower, went up quite a lot, and then come back down a little bit, but it closed above its opening price. So that share actually gained value. So if we look at these and compare them to the other candlesticks, the one on the left hand side would be a red candle, and the one on the right hand side would be a green candle. So right, let's have a look at the chart now. Right, so this is a chart for Barclays on the City Index software. So we don't have to do any of this. All we do is we click on Barclays and it will load up this chart. This is done automatically on a computer system. So you can see along the bottom of the screen you've got the dates, so you can see March 27th and 28th was the last two candles. Up the side you can see the price. Now it goes from sort of 240 to 250, so it's going up in tens. If you zoomed in, and there are options to zoom in, it will actually go up in ones, so you can see it a lot more closely. But now you've seen this, you know what's happening. On green days, you know that the price opened at the base of the green body and it went up and it closed at the top of the green body. The black little bits mean that it went to them prices, but it didn't close or open at them prices. So it's a lot more simple now, isn't it, with if you can actually see. So you know the red candle, the share price lost value that day. The green candle, it increased in value that day. So it's a lot simpler, because if I just showed you this at the beginning of the video, you probably would get a little bit baffled and think, well, I don't know what that is. But now you actually know it's just price movements, and you can see if it went up or went down that day. So it's a lot more simpler once you know what's going on. Okay, so now we can look at a chart and we know what it basically is. It's just a way of presenting information on price movements. But how can we actually forecast what's going to happen next? How could we have looked at that Barclays chart and said, oh, I know what's going to happen next? Well, if you look down the bottom of the screen, there's a single candle or bar. This candle alone does not tell us what's going to happen for the next day or 2 days or next week. It doesn't tell us much at all. But if you actually look at a collection of candles, like on the top of your screen, you've got a collection, and they're actually forming a certain pattern. Now some patterns don't really mean anything, they're not really patterns, but some patterns like this do actually give you a clue as to what's going to happen next. And this is a good pattern for someone who wants the share price to go up. Right, so if we look now, quite a big up candle happened after that pattern, and that was quite predictable, because that is a continuation pattern, so it did mean the share price was likely to go up. The reason why that works is that you've got a lot of traders around the world, people who trade for a living, etc. And if they see a pattern like that, what they will do is they will buy the shares. If there's more buyers than sellers, then what the market makers have to do is move the price upwards. So instead of reducing, like in Tesco's, if you wanted to sell a lot of items because no one was buying them, what you do is you'll move the price down to attract people to buy. Whereas if you're running out of stock, what you could do is put the prices up to discourage people from buying so much. But when it happens on the stock market, what they do is they move the prices up to attract sellers, because if people are trying to buy the shares, they need people to sell the shares. So that's basically how it all works. Right, so probably one of the last hurdles that we need to clear up on this video is the misconception of stock market crashes. People do lose a lot of money on stock market crashes, but when I say people, I mean investors. If you're a trader, you should know that a stock market crash is coming, because you don't just wake up one morning, everything was okay the night before, the market was going up and up and up, and then you wake up and the market's lost half of its value. That doesn't happen. It does show signs. Every single stock market crash in the last, we've had 2 in the last 10 years, or since 2000, they've all shown some sort of sign that they're at such a high price now that they're likely to crash. As a trader, you would pick up on these signs, and in our advanced tutorials we show you lots of signs of stock markets crashing. So you don't need to be worrying about whether the stock market's going to crash, because in fact what we'll be doing is we'll be joining the traders that are actually going to profit from that move. Right, so just before we wrap this video up, we want to show you something. This will be our first little skill that we teach you. It's called the stop loss. What this basically is, on your share account or your trading account, you can buy a share at say £1, and if it goes below that, what you can do is put in an order of what's called a stop loss, where if you can be at work, not, you know, the computer not switched on and all the rest of it. Once you've submitted a stop loss order, it doesn't matter, you don't need to worry about the share price, because if it goes down to the level that you set your stop loss at, the computer will sell your shares automatically for you. And the reason why you want to do that is, if the stock market is going to go down and down and down, and you're still holding shares, they're losing value, so you're losing money. So what you can do is set a stop loss order, so that if they go down a little bit, you sell your shares, you make a little loss, and the market carries on going down and you're not making a loss anymore. You can look to buy them back cheaper and make your money back. So in this example, you've got 4 down days. The market's going down and down and down. We know there's a support line. That might not mean much to you, but we have got a whole tutorial on support lines, so look that one up. You buy on the support line and you put your stop loss just below it. So this would be quite a good trade. You'd probably make money out of this, but let's see what scenarios can develop. Right, so in this situation, we bought and the price actually went down. Our stop loss got activated, so our shares got sold automatically, and then the price went down, but that didn't matter because we only made a little loss. So what we can do is maybe watch how low it goes and then buy it back lower, and then when it comes up to where we originally sold, we'd have made quite a good profit on that move. So it is an insurance policy, and it's something that we recommend, but you need to know where to put stop losses. There's quite a few strategies you can use with stop losses, and we talk you through that on our private lessons. Right, so the other side of that scenario is we buy, it goes a little bit lower the next day, and then it goes up. Our stop loss was in order, so if we bought at £1 and we said, right, at 97 pence, if it goes to that level, we don't really want to be holding the shares anymore, so we put our stop loss at 97 pence. So what will happen is our computer system that we've logged onto, if the share price comes down to 97 pence, it would sell our shares for us. But in this instance it didn't. Let's say for argument's sake it went down to 99 pence and then it went up and up and up and up. We make a good profit on that, and if we did make a loss it'd only be small, but we're actually making quite a big profit now, and that is what being a trader is all about. If you are going to make a mistake, let's cut our losses very quickly, and when we make a good decision, let's ride our profits out. So we want to make small losses and big profits, because you can make a few mistakes. Everyone is going to make a few mistakes, or you might make a really good trading decision but the market just go against you. So you want to make a little loss, recover, and then make a big profit, and that's what trading is all about. So that wraps up your first lesson. If you want to learn more, we've got quite a few tutorials to watch. We've got some advanced tutorials on our members section of our website. They are quite advanced, but if you can get your head around them, then you'll be quite a good trader, and we can do private lessons and things for people who need a bit more help, and there's other things we teach on private lessons. So it's, as you can see from this video, it's really not as hard as it sounds. So it's yeah, it's good. So good luck trading, guys. Good luck.